Let's introduce on the show Mr. Rajesh Cheruvu. He's the CIO of Validus Wealth. Mr. Cheruvu, thank you so much for taking our time and joining us today on the show. So to start with, we might as well discuss this topic so that if individuals do want to, include gold in their portfolio, it's a great time to do so. So tell us, Mr. Cheruvu, why do you think it's important that individuals have some of their money? And, I want to talk about the younger ones as well, because if you talk about, the older generations prior to millennials, Gen X, etc., baby boomers, they'll always have gold. But if I talk to millennials, Gen Z, you can forget about gold for them, right, in their portfolio. Do you think it's important for them as well?
Yes, thank you very much. Yes, absolutely, you're right in that sense. The holding gold in portfolios, we believe it plays an important role as a hedge against inflation risk as well macro risks. So that most of the people tend to think gold as a passive asset, which doesn't generate, which is not a productive asset, but it plays as an insurance in portfolios. So one should not ignore the role of gold in their portfolios.
All right. So it's absolutely important that everyone does have a little bit of gold in their portfolio, even though they may think that it's a very old generation asset class. But yes, it acts as a hedge against many of the other risk factors that equities can bring along. Now the question is, sir, how much gold is enough in your portfolio?
So in general, based on, I think, various simulations and various studies we have conducted, we have realized at least on an average, one should have around 5% as their strategic asset allocation in there as part of their financial investment portfolio. I'm not talking about the consumption portion. That is completely different. As part of the financial investment, one should have about 5%. Financial asset, I mean ETFs and sovereign gold bond kind of, I think, easily liquidable assets. One could have it. But this 5% is not static, not necessary to be static. When risks are rising, like the way we have seen in March 20, like such pandemic times, it can go as much as to 10%. Similarly, during exuberant times or expansionary times, it could come off to 2.5% as tactical changes in the portfolio. But as a strategic asset allocation, one should consider it by 5%. Tactically, based on the market conditions and macro conditions and risk conditions, they could move either side tactically.
Okay, so does that mean that there's no fixed quantum and that you need to keep monitoring how things are moving? And accordingly keep changing gold? And also, is gold the one asset class that does not depend on your age as well? Because, we say when you're younger, put more in equities, you can take on more risk, and then as you grow older, move it slowly into more secure assets. So is this independent of age?
Yeah, this is an alternative asset class. This has a certain amount of inverse relationship with both debt as well equity. So as an alternative asset class, during when you are having a higher equity, that time also it is providing as an insurance to your equity portion of the portfolio. As you grow in age, your fixed income component tend to rise, and during those times, it also offers insurance to that portion too. So it not necessary to change. So on an average, I think strategic asset allocation, one could have about 5%. And as I've suggested earlier, one could change the tactically from time to time.
Okay, understood. Now, of course, the question is, now all of our households, especially in India, have gold in some form or the other, right? We get it on special occasions, weddings, birthdays, a coin here, a coin there. Then let's not forget ancestral jewelry, which has been passed on from, grandmothers, etc. Is that a part of your, your portfolio, what you mentioned, the tactical allocation bit, etc.? Because I find it hard to imagine, taking that ring and taking that earring and going about, to change my strategy and my portfolio composition with that.
You're absolutely right. I think the gold, whatever we buy in physical form, that is whether it is in the form of coins or jewelry or ornaments, these things tend to pass on from generation to generation. In general, we don't actually monetize that. So that is a part. So that cannot be considered as an insurance for our financial portfolio. So as part of the financial portfolio and financial investment, so we have to look at other routes to market like ETFs, gold ETFs and sovereign gold bonds. These are the two appropriate routes to market or approaches to accumulate as a financial instrument. ETFs typically track global gold prices, global commodity prices, gold commodity prices. Similarly, sovereign gold bonds issued by Government of India almost month on month, they keep issuing it. Coming Monday, they're coming with one more issuance, so which also carry 2.5%. So people whoever have concern with respect to, I think gold doesn't yield anything, which is unproductive asset. So this sovereign gold bond typically gives 2.5% yield. Every half yearly it is paid. And on maturity at the end of 8 years, if someone government repays at prevailing gold price, but that time you don't need to pay any, investor doesn't need to pay any capital gains tax on it. So it is a good win-win that way. So these are the two financial instruments available in India. So just one could look at them as part of the portfolio allocation.
Okay, since you've brought about the topic of sovereign gold bond schemes, let's talk about this upcoming series as well. The dates have been announced for the new fiscal year. 17th May, we'll have the first series that will launch. I don't think we have the pricing yet with us. Yeah, no, I don't see it anywhere as such. But yeah, how is the pricing of these bonds determined? They are released almost every month. And does it matter really on how we go about investing in these SGBs, or do we pick up little bit by bit every month? Do we subscribe to few bonds this month, then a few next month? How do you go about building that corpus then for gold?
Yeah, obviously. So it is very difficult to time the market, especially in any, for that matter, any financial markets or any financial instrument that also applicable to gold as market instrument. So it is wiser and it is advisable to do it on a tranche by tranche, as you brought up. I think every month government is issuing these SGBs. Every month certain amount can be set aside as part of the portfolio allocation. One could look at that. And what we suggest is, in general, for example, 5% allocation I spoke about earlier, that is our strategic asset allocation. What we are suggest investors to look at is half of it through exchange traded ETF route, and that is easily liquidable. Okay, remaining 50% means another 2.5% can be bought through SGBs, sovereign.
Okay, I think we just lost Mr. Cheruvu's feed. But yeah, we were talking about sovereign gold bond schemes, and it's obviously very difficult to time the market. Gold more so, because there are lots of macroeconomic factors involved which do tend to move gold. Remember, India is not a gold price maker. We are a gold price taker. What happens in the US markets is what we pick up, even though, of course, we are one of the largest gold consuming countries. But yeah, we are back with Mr. Cheruvu. So continue with your point, sir.
Yeah. So what I would suggest is that 50% of the allocation through ETFs and 50% of the allocation through SGBs are advisable. And these SGBs can be accumulated month on month during issuance, during public issues can be accumulated. And the pricing is also quite favorable for retail investors. Government is giving every month 50 rupees to the prevailing price discount they are offering it. So taxation wise also it is in favor, 2.5% yield is also carried. So it is all in all, I think it is partly through ETFs and partly through SGBs are advised.
Okay. Understood. Of course, the SGB is not the only way when it comes to investing in gold. You have other ways as well. Now a lot of mutual funds, they have the gold funds. You have ETFs, etc. So what's your view on, those methods of investing?
Yeah, ETFs can be bought through exchanges and through brokers. One can buy that, but there one needs to be conscious. One need to be mindful because there is a underlying price value, underlying net asset value of the asset and price. Yeah. There is an impact cost because of the liquidity, and because of the volumes prevailing in each of these ETFs. There could be spreads could be quite wider, and one needs to be mindful. I think they have to take an appropriate advice from professional advice. They have to seek where that spread is quite narrow. And that is most important. That's most important thing. Whereas means I think there is an AIMS asset management company which is offering ETF, which is having a huge assets. Their the liquidity could be higher. There in those places spread could be quite narrow. And from investor perspective, spread should be as low as possible. Tracking error should be as low as possible in ETF. That is most important thing to take care of.
Okay, and if I have to talk about, in terms of all the pros and cons of all of these different kinds of methods of investing in gold, and I'm going to take, bars and coins as well for the benefit of our viewers so that they get a comprehensive picture. Out of the entire gold investment that I have, how much should be in each of these different ways?
So I would suggest, I think physical gold, as long as it is not meant for the personal consumption like ornaments or jewelry, it is not advisable to have it because the risks of storage and the cost of storage also matters there. Okay. So as long as it's not meant for the consumption, it should be avoided and it should be taken through financial instruments only, because these can be, I think, if tomorrow as there are certain catalysts, there are certain triggers. I think gold prices, for example, if they keep sharply move up, if one wants to monetize and one wants to take advantage of that market condition, physical gold one cannot actually monetize as easy as ETFs or SGBs. So other than consumption can go into through financial instruments, only consumption gold should go into physical form. That is the suggestion to investors.
Okay, so take gold in the physical form only, limited to what's not used for consumption, not jewelry and etc. It can be in the form of coins, etc., but limited. Keep it more in the financial form. Well, Mr. Cheruvu, with that, we're out of time, so we leave it at that. Thank you so much for joining us today on this occasion, Akshaya Tritiya, to talk about gold investments.
Thank you. Thank you very much.